There's times for money to be in the market, right? You got to be diversified, and that's part of an overall portfolio. But sometimes on days where the market is kind of shaky, it's nice to have this portion of your portfolio protected.
I'm Becky Kiser, Hayes Post Eagle Radio News reporter, and I'm talking with Brian Weimer from IPI Financial Services in Hayes. We're talking about multi-year guaranteed annuities on this episode of the Hayes Post podcast. We're going to talk about something today that some people in our audience may be familiar with, others may not, and I have to confess, I've heard of it, but I really don't know what this tool, this opportunity is that you're going to talk about. Multi-year guaranteed annuities. What a name, too. What all does that mean exactly, Brian?
Yeah, kind of just what it says. Multi-year, meaning that the guaranteed interest rate that we'll talk about is guaranteed for multiple years, and you can determine how long you want that guarantee to be. 2 years all the way out to 10 years with some companies. So the multi-year part of the title is just how long you want that guarantee to be. And then the multi-year guaranteed, the interest rate that you lock in for that term is guaranteed for the length of the contract. So the multi-year guaranteed, and then the annuity contract is just the name of the contract itself, the wrapper, if you will, of the policy.
Now, is this something that we really should be taking a look at, depending on your financial situation at the period of life that you're in? But I'm thinking about the market and how we've had some volatility earlier in this week. And then, of course, our interest rates have been kind of crazy lately as well.
Right. So these contracts are for those investors that have a more conservative risk tolerance overall, or just on a portion of their portfolio that they want to put a protection on or a guarantee on. That's where these contracts fit really nicely. We probably use them more for clients that are approaching retirement or even are in retirement. And then with interest rates the way they are currently, the last year and a half, 2 years, interest rates have really increased. And that's had an impact on these contracts as well, because the interest rates that we can lock in are higher. Much like your CDs at the bank. The rates are higher now than they were 2 years ago or 3 years ago. These contracts are going to work the same way.
Have these been around a while?
They have. These contracts have been around a long time. I would call them maybe the second generation of an annuity that came out, the first one being an immediate annuity. And then these fixed annuities were probably the next type of contract that came out. So they're hundreds of years old. And they're offered by lots of different insurance companies. And so it's a product that's been around for a long time.
And when you said insurance, it made me think, are these insured by the FDIC, like a CD or something? Yeah,
great question. So that is one big difference between the CD and the annuity. So the CD is obviously insured by the FDIC. With the annuity contracts, these fixed annuities, they are not FDIC insured. They are guaranteed by the insurance company that's offering them. So the guaranteed interest rate, the guarantees of the contract are all backed by that insurance company. And so you want to make sure that the company that you're purchasing it from is a solid financial company that can stand by those guarantees for the long term.
IPI Financial Services being a great example of that.
Well, thank you. Yeah.
And we want to also ask, I'm curious, you talked about focusing a lot on maybe people who are about to retire or actually in retirement. What about younger people? Is this something that they should look at down the road or when they're still, working quite a bit? Yeah.
So for some of the benefits of the contracts are guaranteed interest rates. Another benefit of the contract is that if it's what we call a non-qualified annuity, that interest is going to grow tax deferred. Okay, the contracts can be non-qualified. It can be an IRA. It can be a Roth IRA. So the structure of the fixed annuity can have different purposes. One thing for younger clients, if they are going to look at this type of contract, the thing that we have to remember and make sure they understand is that there's penalties. If you are under 59 and a half, much like an IRA, if you're under 59 and a half and you take money out of the contract, you could be subject to a 10% penalty from the IRS on the gains, or if it's an IRA, on the entire amount that you pull out. So there are some, just like anything, there's benefits to the contract if used correctly. But we also have to be aware of the things that could create a negative spin on the contract. And that could be surrender penalties or early withdrawal penalties. So those are things that we always make sure that our clients understand and are aware of to make sure that if we are recommending this type of product, it's in their best interest.
Does that happen very often that people do need to surrender earlier, or and why would that occur?
Yeah, good question. It's in my experience, it doesn't happen very often, and I think one of the important things to understand is that these contracts are more long term. They can be longer term contracts, so it's really important that our clients, we try to make sure that they're positioned to have plenty of liquidity, so that if they need money, if an emergency comes up, we don't have to take it from this particular contract. They have their liquidity in bank accounts or money market accounts, or maybe even CDs that can be accessed with no penalty or very little penalty compared to maybe this annuity contract. So making sure that clients have enough liquidity is number one.
So part of an entire portfolio. How about beneficiaries? Are you able to determine who those are?
Yes, you are. So the contract usually has three parts: an owner of the contract, and that is who we take instruction from. That's who is in control of the contract, the policy. And then you have an annuitant. With an annuity, there's an annuitant, which is the person that if the contract was going to be turned into it was going to be annuitized, which means it's going to be turned into a stream of income that can never be outlived. That payout is going to be based off of the annuitant's age. And then the third party to the contract is the beneficiary. So the owner gets to determine who they want to list as the beneficiary. So if Becky, if you opened up one of these contracts, you could be the owner, you would be the annuitant. And if it was in your heart and you wanted to list me as the beneficiary, you could do that. You could list whoever you wanted to as the beneficiary of that contract. And then if something happened to you, that's who the money is going to be paid out to, is that beneficiary.
You have listed a benefit of these also, of the multi-year guaranteed annuities, is principal protection. What does that mean exactly?
Yeah, so what that would refer to is if you put in a sum of money, and these are typically single premium contracts, so you can only put money in once, and that is your principal, what you put in. So if you put in $50,000, for example, that's your principal. So with these contracts, that principal is guaranteed, and now you're earning the interest on that principal. So there's no market risk on the contract. There's no fees in the contracts. So it's just a principal protected contract where you're getting a guaranteed interest rate that accrues daily. So every day, if you go in, I always tell our clients, if you go in and look at this on a daily basis, which I don't think you need to, but if you wanted to, you would notice that each day that you look at it, it's worth a little bit more than it was the day before.
Oh, I'd like to see my growth going up a little bit every
especially
day.
after. And there's times for money to be in the market, right? You got to be diversified, and that's part of an overall portfolio. But sometimes on days where the market is kind of shaky, it's nice to have this portion of your portfolio protected.
That makes me think, and I mentioned it a moment ago, what the market did. I think it was on Monday that just there was some really low numbers coming in, and then that's just the way the market goes, I think, is what people say. One day it's way down, and then the next day we had recovery.
Correct. Yeah, that's the market. And with these contracts, there would not be any of that volatility. They're guaranteed, and like I mentioned earlier, that interest accrues daily. So each day it's going to be worth a little bit more. You would not see a decline in your account balance. The only way that would happen is if you're taking money out. That's when the balance would be reduced.
Do you have a recommendation to people, or does it vary on what that principal amount should be? Is more better?
Yeah. So it's all based on the investor and their risk tolerance, their age. Do we need the money? Are we going to possibly need the interest from the contract? Because as that interest is being earned, you could take that interest out and use it for living expenses if you wanted to. So the amount that needs to be placed into the contract, it is all based on the individual client or that family unit on how much they want protected or how much maybe we feel they need protected in their overall portfolio.
Is there a a percentage of the portfolio that you think would be good for the average investor? I mean, we're not talking 99%, obviously.
Yeah, a lot. It comes down to age and really risk tolerance, because some people, I have clients that are close to retirement or even in retirement that they still have a very growth-oriented or aggressive risk tolerance. And that might be because they have guaranteed income that's going to be coming in through maybe a pension or Social Security. And then I have other clients who might be younger and their risk tolerance is more conservative, and they don't like to have market exposure or see the ups and downs. And so it's individually based. Our job as the advisor is to help them understand why they might need some market exposure, but also why a nice fixed contract like this could fit into place as well within their portfolio.
And I think that's one of the great things about IPI Financial Services being local and people like yourself. You sit down with the investor across from your desk and just talk about things, get to know them and what their needs and wants are, and just detail it according to what their personal lifestyle is going to be, what they expect.
Absolutely, and that's something that we take very seriously. To me, I tell my clients all the time that this relationship or this plan, it's bigger than the numbers, right? It's bigger than the contract that we're going to open up or the allocation or your portfolio. It's about the relationship, and I always want my clients to work with somebody they know, like, and trust. And if that's me, great. If it's not, I hope you find that person, because ultimately that's the most important thing, is to work with somebody like that. And then you can build a really strong relationship, and you start to talk about more than the numbers. You're talking about life. You're talking about events that have happened. You're talking about kids. You're talking about sporting events. You might spend 15 minutes talking about the actual portfolio or what we've done, and the other 45 minutes, if it's an hour meeting, you're talking about life. And that's what brings me the most joy.
That's what it's all about.
Amen.
We have been talking with Brian Weimer from IPI Financial Services here in Hayes, talking about today multi-year guaranteed annuities. And people, if they're curious about this or would like more information, what's the best way to get hold of you, Brian?
Yeah, you can stop by our office. So 3004 Broadway, IPI Financial Services. We're right next door to the insurance planning building. Or you can give us a call at 785-625-5605. Or probably the best thing, just stop by and we'll set up a time to chat.